We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Trader Ferg, full-time trader and author of the Trader Ferg Substack. Ferg, thanks for joining me today. How are you?
Great, thanks, Tom. Thank you for having me back on. Love the show.
Thank you. It's always a pleasure to speak with you and, throw some of these ideas back and forth. And of course, the last time I had you on, something we spoke about was your views on a particular asset class being beaten up by the narrative, and really how you take the time to try and analyze it for its merits or its value, despite what the story of the day is saying. So I'm specifically thinking about how you described the platinum industry, that supply deficit, and really everything surrounding that. And of course, we've seen a dramatic 50% rise in the platinum price since that call that you and I did in January. And obviously, a lot of that rise in the price was concentrated over the last month. So when we see a dramatic rise like this, basically a 50% run, does this change your view on the metal and, let's say, how you express that view via your position?
Not really. I want to be positioned before the move. Obviously, that's my entire strategy, is seeking out these hated assets and trying to get in there early. And then my whole strategy revolves around kind of seeing sectors that have been left for dead and then starting to question why they're in that sort of bottom crawling process. Kind of like I called it, like a sort of almost like when you see the patient heartbeat and then when they die and it goes flat. And now what this recent breakout I would call like the first sign of life. The sector's coming back, and platinum in particular is like the absolute pinnacle of that chart, because that chart's been in the sideways trading range for nearly a decade. Like, talk about an absolutely frustrating hold if you're holding that and looking at the relative performance to something like gold or something, even obviously anything in the US equities. The underperformance has been horrific. And so that the interesting thing when I saw it was, I love the supply side, so I instantly started digging in there, and just to see how bad it had got. Like, the latest figures from the World Platinum Council is that the primary supply is down 6% year on year, and that is also against the recycling, which makes up a decent proportion of platinum and PGMs, is also continually disappointing. I've got like a chart where it shows every year they're trying to forecast that it'll bounce, and every year it disappoints. And there's a few reasons for that. Mainly, I believe it's cars are lasting longer. There's kind of a squeeze on a lot of people's finance, so they're holding on to their vehicles for longer. So there's no recycling, and the catalytic converter is not getting recycled, so that secondary supply is not coming in. So that's also down year on year, and the inventories are drawing. And what actually has created this recent sort of price rise wasn't even catalytic converters, wasn't the industrial demand. Each of them sort of roughly around a third. It's just been pure investment and jewelry demand, and that's mainly from sort of foreign. A lot of Chinese buyers are substituting on the back of gold, just doing what it is. So they're now coming. You can obviously, it's quite easy to substitute white gold for platinum, and there's even been quite substantial demand for bars, and increasingly for even sort of investment products. And so, that's really brought it into the spotlight. For investments, it's got such a narrow little group of producers that actually mine the stuff. Most of them are based particularly for platinum in South Africa. So you've just got a handful, really. You've got 3 to pick from. And they've all been doing good things. And I like to try and spot the stuff early so I can get a good price before the breakout occurs, and then it's my kind of whole way I come out stuff is I really want the maximum asymmetry. If I think this is going to be something that trends for a number of years, I want to really optimize my kind of buy price so I can sit back and just put it in the portfolio and forget about it for 5 years. And so getting in before it really gets the attention on it and starts to move is kind of key for me.
So, inherent in exactly what you're saying about trying to position early and really getting this position before this sector gets any attention, how do you think about, let's say, the timing on these things? Obviously, platinum, the fundamentals were extremely bullish. The supply deficit was, basically going nowhere but up. And it seems like we need a catalyst. See what I did there? To really get it moving.
I like it. Yeah.
So we need a catalyst to really get it moving sometimes, despite the fundamentals. So how do you think of this, let's say, this opportunity cost?
Yeah, well, this is the trickiest thing. So it's fine to say being early, but often I think it's Howard Marks said sometimes being early is indistinguishable from being wrong. And I've been like flat out wrong a few times in the past. The most wrong I've been was probably been holding some offshore drillers before March, going into sort of March 2020, and they went bust. So that was early and wrong and lost the money. Then you've got being early and just getting punished. And to an extent, the PGM trade I was. So I went into the likes of Sibanye, $4.50, I think was the first, and then saw that go all the way down to $3. So some people would at the low, and so some people would say like that's like stomach churning volatility, and is that wrong? Sort of stomaching that much, but if you add to it, added more positions, really sized it up, and obviously all the equities are worked, and even that original position size is looking reasonably good as of where prices are now. And so that's kind of like an example. So there's I guess there's a few parts to that. That's having to be willing to cop a bit of volatility, because all this stuff is very volatile and kind of goes hand in hand with large upside. Is you'll often have to take pretty substantial drawdowns. So that's where like position sizing is super important. I'm like a kind of very clear on how I like to position size stuff so that I can handle the volatility. And then I guess it's also having an eye that there's enough catalysts that you're not going to be sitting this thing like it could have been making some of these cases like 2-3 years ago. And that would have been like wrong with the sort of just the sheer opportunity cost it would have put on you. So yeah, it's the biggest art in this game is being close enough to a catalyst that you don't just have a massive opportunity cost of sitting on capital for years. And with some of these, especially miners, they are essentially like you are getting time decay often and dilution. They're just printing shares, so you're actually losing your ownership that way. Just sheer operational risk as just miners do dumb stuff every day, so you have to get your ass handed to you that way as well. Mm-hmm. So it's honestly the trickiest thing is that interplay between waiting for the clear like Thunderberg's a go sign when there's a clear breakout and trying to get in before that. Yeah, I'm still working on it.
Well, I think that's something that we're constantly needing to work on and to learn different techniques. And in order to, let's say, optimize that entry point or delay that opportunity cost as much as possible. So, you recently wrote about, and I think you put it in a really interesting way, this balancing act between risk minimization and regret minimization. So how do you frame it through that way of thinking about it?
Yeah, so I think this is one of the most important things anyone can kind of conceptualize is there's a lot of strategies out there that you can make work if you've got really good portfolio management. And so this is kind of like I see a lot of people that are like focused on like win-loss ratio, like a lot of the Forex traders. And if you've got great portfolio management, good position size, and you can make something work that's got like 50-50 win-loss if you just cut your winners ruthlessly and let your winners run, like it can work. And so that piece that I wrote about there is adapting it to my style. And that was all around how do I optimize the position size that I minimize my risk, because risk is number one. Like it's really hard to come back from. So say if you have a large position and you take a drawdown, the amount you have to get back to get to where the amount you lost just becomes astronomical. Like I can't remember the exact percentages, but it's something like you need, by the time you've had like a 90% drawdown, you need like a I forget what it was, like 7 or 8x or something like that to get back to break even. So it becomes so difficult. And yet at the same time, having tiny position sizes, like just limiting yourself to 1% for all positions, that in itself has an opportunity cost that it carries. And that's what I kind of labeled regret minimization, that if that position turns out to be the multi-bagger, then at a 1% position, it doesn't actually move the needle on the portfolio. And you need those big winners to move the needle, because they don't come along that often, and they need to make up for some of your mistakes. And so that's where the regret minimization comes in which where is the optimal amount that I can still sleep with at night if I am wrong, and yet if I'm right, it really moves the needle. And for me, that at a starting point in a position, it's about 3%. So if I lose that 3%, yeah, that hurts. It's painful, but I can come back from that. And if I hit it out of the park with 3%, well, if there's a 10 bagger, adding a third to the portfolio, and then from that 3%, if I keep doing work on the company, maybe it has a pullback and I've built some conviction, then I can take it up 4 or 5. And then if you hit it out of the park with 5% position, now you've added 50% to your portfolio. So yeah, it's that interplay. And I don't see a lot of people focused on the sort of the risk minimization, sort of the 1%, but very few people talk about the regret minimization. And yeah, I think that's almost to a point that's like almost more important, because yeah, so I highly recommend everyone, if anyone hasn't heard of it, I'd recommend to go get it. And it's this book called The Art of Execution by Lee Freeman Shaw. And he was a fund of fund managers, and his entire career he's just essentially allocating capital to a whole lot of fund managers, and then watching them. And over his career, he categorized all the way that their behaviors, and he labels them all. So he calls some rabbits, some raiders. Like the rabbits were some when they had a drawdown that stick their head in the ground and refused to do anything. And he said they were always doomed. But interesting enough, the ones that were the best performers of that he watched his whole career, he called them the connoisseurs. They were the ones that could position size correctly and then just hold it for extended periods. And they would only trim very little amounts. And then I think his tagline is like the only way to like really outperform over extended periods is to be able to hang on to position size correctly and hang on to winners and let them grow really large. And so that always stuck with me, that you have to have starters, you have to have enough on the table, and then you need to let it grow. And yeah, that's where that whole sort of framework came from. Was so to summarize, it's that starting at 3% and building up to 5 is my sweet spot that I've come to over the years.
Mm-hmm. So going back to this, let's say, fundamental picture for platinum, even going forward from here after this rise, what do you see as other, let's say, avenues of demand that are important in the, let's say, medium term?
Sure. So platinum is one of the more interesting ones from that angle, because you've got such diverse demand. Like if you're talking palladium, you're 80% catalytic converted. So it's really just a play on auto demand, similar to rhodium. Rhodium's even more intense on the back of that. That's like 85% catalytic converters. With platinum, you're only 37, 38% catalytic converted to demand, which in itself has got its. So I've got a strong view there that we're going to see hybrids take off, and there's going to be a lot of first new buyers in the developing world on the back of. Well, I'm seeing it here in Indonesia with the likes of BYD. Granted, they're currently in a price war, which is perhaps not great for the immediate term, but I guess zooming back with platinum, just to break it down, what the demand drivers are. You've got catalytic converters, sort of 37, 38, maybe 40% some years. You got industrial demand, which is about a third. You've got jewelry, which is about just under a third, and then you've got investment demand, which is has been very little the past few years, but is really picking up now with gold doing its thing. And so you've got those are demand drivers, and as I mentioned before, the big demand, what's really jumped lately has been the demand for jewelry and for investment, and that's largely out of developing countries, largely out of China actually, and that's substitution effect for gold. But my view is that this is just getting started. If you're going to zoom out, this is going to be the start of a really large move for years to come. Granted, there'll be volatility. Maybe this currently pulls back. The reason for that is the industrial side. That's super negative at the moment. The forecast on that is negative 15% year on year from the Global Platinum Council, and all of that stuff's quite cyclical. So that's all quite tied to sort of industrial growth. And I've got a whole theory around the fact that we're actually going to see really, well, it's not really a theory. It's like, I think what everyone's talking about is kind of reshoring, and on the back of that, we're going to see a lot of capital expenditure, and that's going to really benefit a lot of the industrial applications that platinum's in. A lot of sort of chemicals, a lot of factories in glass, and coming off negative 15% year on year, I think it could bounce really heavily, and that's a lot of this needs to be taken in context that the supply side's like super tight. So for anyone that doesn't know, the overall supply side, it was negative 4% year, negative 6% year on year, and the entire demand side, I think, was negative 3 or 4, and so it still can't balance. And in the demand side, everything is all the forecasts are really negative. So industrial down 15% year on year. So if that turns out to be too negative and bounces back, then the supply side can't, because primary mine supply in South Africa is an absolute mess. The inventories, like the stocks, are down to 3 months. So that's like an absolute record low. And that understates how bad it is, because it's been drawing down for a number of years, but it's been getting largely cornered by the Chinese. And the Chinese don't export platinum. They do export it, but in value add. They won't export the raw product. And so they've largely cornered a large portion of global platinum stocks. And a number of countries like Japan and Europe, which used to hold significant amounts of platinum, they're actually now hand to mouth. And so that makes me more bullish, is the fact that they're just going to, if they want to get their hands on it, they're going to have to pay up. And so over a limited amount, with all things being equal, means price will have to react. So yeah, industrial, I see that is cyclical, and I see that bouncing back. I think when I was last on your show, I went through the whole catalytic converter. I've got a whole thesis around that it's largely going to be hybrids are going to take off, and that they obviously all use a catalytic converter. So all the forecasts of EVs taking over the world, I don't think that's going to be correct. And so there's going to be a lot more demand for catalytic converters. So all those forecasts, that say demand will be very weak, will prove to be incorrect. And I see gold going a lot higher. And so by default, I see that dragging up platinum investment demand and jewelry demand. So overall, I see all the immediate term, which has caused the spike, is jewelry investment. And I see each of the other sectors starting to pull its weight over the medium term and longer term as well. So yeah, I really like the trend for years to come.
Mm-hmm. You recently wrote a piece explaining that when shorts across an entire sector, which is in deep deficit, that it's just a matter of time before a spark sets off a reflexive cycle. So do you see silver as maybe being an exception to this thesis, considering its track record, or is there more to the story to consider with silver as well?
Oh no, I think silver does the same as platinum. I honestly think all of them play a big game of catch up. I think when you zoom out, you realize like the story that got sold on like Doge and we're going to get the deficit under control. And like if you like back out to the macro, I think a lot of the moves we're seeing is just the realization like this thing isn't gonna have a happy ending. This is gonna like really at the core level, you either have taxes that are approved or everyone gets their income taxed by inflation, which isn't approved. And that's what they're choosing by running the big deficit. Anyone that can do basic maths like this, these numbers don't work. So they're going to have to print the difference. That means inflation, and that means your purchasing power is going to be heavily taxed. And it's really just a result of like there's no willingness to reduce entitlements. And so the way you reduce entitlements is by still giving the person their promised amount in a few years, giving them their 1,000 a month, but that 1,000 won't be 1,000 by that point. It'll be a fraction of that, and so that's a tax, and that's inflation, and that ties back to the whole commodity complex, and in particular at the moment the precious metals, because they are the cleanest expression of this. Gold's the best expression because you've got obviously central bank buying, but once that band gets too wide, then people are going to start jumping, as we have seen on silver and platinum. They've also got their own drivers as well. And
kind of as a substitution to gold?
Yeah. That band can only get so wide in my view, or maybe it can get wider. I like playing gold in its own right via the miners, because the miners, I was just looking before I jumped on the show, and I'm still amazed that GDX and GDXJ haven't even managed to get any positive inflows. They're still highly negative. GDXJ doesn't even had 1 week of inflows for the last year, still at 2 billion of outflows, which is, if anyone thinks they've missed a gold move, just look at the miners. So I think that whole complex does amazingly, and it's coming back to what we talked about. First, it's getting in cheaply, and you get a lot of asymmetry getting into something before it really starts to play that game of catch up. And I just chose platinum and PGMs in general over silver because I feel the supply side's a bit tighter. I guess we'll know in the future which has the biggest outperformance, I guess. But yeah, I'm convinced at the moment that everything with PGMs looks, particular platinum and rhodium, look a lot tighter to me.
When we consider, as you mentioned, the central bank demand for gold, and we look at the let's say overall fundamental picture here, what do you think is, let's say, the next meaningful source of demand for gold looking out in your view here?
It's really institutions and retail all deciding to, like I just mentioned, the inflows to investment products. You can actually compare Chinese gold investment products are getting great inflows. So the Chinese retail are already all over this. It's just for whatever reason, Western retail is just not interested. They're still doing well, obviously, in US tech. they've got crypto that some argue has replaced the whole speculative sort of mining space, which does make sense, I guess. But I think there will be a big performance chase at some point, and when that actually kicks off, I'm not really sure. But I see gold continuing to grind higher, and eventually that'll attract sort of large retail participation and institutions. I was talking to Robert Mullen, who's a portfolio manager at Marathon Resources, and he was saying, I believe it was UBS, I think it was their high net worth clients. I might be messing that up. They're still only at sort of 1% gold, and it's kind of fascinating that it's still that low with the sort of the outlook we're seeing at the moment. And so it's not only retail; it's kind of like the sort of institutional and smart money still at record low levels. It's really, at this point, it's only been central bank buying and very little retail. The only retail is kind of more pragmatic sort of Asian countries.
Mm-hmm. Do you think if we go back to, let's say, a meaningful type of stimulus from central banks, that can prove to be, let's say, that next catalyst for that next leg?
Yeah, no, certainly. Like if we see, well, whatever it could be, and I think if inflation rips, then it's game on. So everyone should understand then that it's just a game of protecting purchasing power. We're at this point in time at the moment where obviously everyone's pointing to how low inflation's got, but anyone that studied history, inflation comes in waves, and there's I feel like we're at the bottom of the first wave and the second wave's coming. And where we are at the moment of Trump shutting at Powell, that needs to lower rates, and it's just going to be, we'll look back at, sorry, my toddler's trying to break in. We'll look back at this period as it's like a calm before the storm, and I just see that as a period before everyone realizes like inflation is coming back and protecting purchasing power, and whether this is on the back of also equities underperforming, could well be. I'm not sure exactly what the catalyst will be to turn everyone's attention to it, but I just figure it'll happen with the setup we're facing.
Mm-hmm. Do you think much of this idea of shorts being present applies to much of the mining sector in general?
Yeah, well, so this is the most interesting question: is what are they doing in different areas? Like so in my portfolio, I've got some really high interest in companies that I have really high conviction on. So a large position in the likes of Valaris, and that got up to 20% short interest. And so you got to ask yourself, like, am I wrong? Like shorts aren't stupid. Like what are they doing here? So with some of these companies, I believe they're pods, and they're just looking for short-term earnings per share revisions for the next quarter, and so they're just playing for that quarter. They don't really care where the company is in the next year. They just want to play for the short term. So kind of, I'm fine with that. There's others like Uranium, which, like the piece you noted, where I started the piece with just Zoolander, and they just spraying petrol all over each other, and I think that was an easy setup to spot that didn't make sense, and that seems to be that they're almost overlaying like the whole lithium thesis, that the whole thing's just going to grind lower. And there was talk of Spot was going to run out of cash and was going to have to sell some pounds, and then obviously since then they've had a raise. The shorts they haven't even been burned that badly. Like there's still quite high short interest in a lot of these names. So they're still hanging in there, even though they're well underwater now at this point, which is kind of fascinating to see. But it is a nice short to be short miners, because it's a tough business. They get sold off heavily in any sort of market downturn. And yet, for all of us that are sort of focused on fundamentals, the fundamentals setup is there, and the fact that demand is coming down the pipeline. It's not sort of it's not evaporating. Like, the utilities do have to buy at a certain amount. Yes, they haven't to date. Yes, they're still quiet at the moment. And the current ramp in uranium was just on the back of Sprott with having sort of a financing and raising 200 million and buying more pounds. But there's still a lot of utility buying to come, and so I think the shorts are playing with fire, which is kind of what I was getting at with that whole Zoolander meme.
Well, exactly in that, that line of thinking for uranium here. Again, we've seen a pretty decent move. So once we see this initial move and response from the market and response, let's say, from investors, as you look out over towards the end of this decade and into the early 2030s here, it seems to me like the supply demand picture only gets wider for uranium as well. So does that that fundamental picture give you, I guess, let you rest easier, considering that this is a fairly long-term basically hold for you?
Yeah, no, certainly. The problem with uranium has always been that you've got really poor ways to express a view. Like, you've got a whole lot of miners that are promising that they'll get into production. If you look at history, most of them don't. And so I've always said with uranium, it's the most airtight thesis, but it's got the worst ways to apply the view. There's no getting around it. It's one of those weird ones where across almost every commodity, you've got no line of sight on demand. You can focus all you want on supply, you can work out supply, but you don't know what demand could be. With your uranium, like you can literally work out what are operating reactors, what do they require, and how many reactors are under construction. So this big wall of demand is coming. It's just taken a lot longer to get here than most thought. There was a lot more sort of inventories lying around. There was a lot more flex in a lot of the utilities contracts, but it doesn't change that outlook. And I think the sector is going to be going to continue to do really good things when that finally bites. When that bites, I don't know, and I think across all the experts have been proven that no one really knows. And it's kind of a weird. It's the most opaque. Like, if anyone digs into how the contracts are actually done, it's the most opaque, weird sector where they don't even report where the deals were done. They report the lowest bid, like for the price, which is just crazy. I don't even know how that ever even got approved. And a lot of them don't even report their contracts. So you got to kind of try and back it out from their future filings. So it's just super opaque. But the numbers don't lie, that there isn't enough being mined, and we know what the demand is. So I think it continues to do great things, but it's been a tough hold for anyone that's bought in the last few years with that thesis.
Again, this idea to me of zooming out to get this larger picture, I think is so important, and it's something that I was actually talking about recently. Is anything that is really worth doing takes time to do, and I think that also applies to investing. So, adding another layer to this, let's say, fundamental understanding of where much of, let's say, the metals complex, the energy complex is headed, does the addition of, let's say, the cyclical nature of how CapEx comes into the space give us, again, more comfort or any understanding on timing when this type of spending comes back into much of, let's say, the mining sector or drilling sector?
I think the best quote I heard was one from, what was his name? He used to work for Goldman Sachs, Jeff. I'm blanking on his name, but anyway, he said, Yeah, Jeff Curry, that's who it is. Yeah. And he was saying before, sort of the larger money to come in and start funding this stuff, they need to see the bottom end. They need to see sort of that they're not going to risk trying to call the inflection, and so they need to see so the prices start to do good things for 3 years. Once it's de-risked, they'll then join the party 3 years in. They'll then fund it for the next 6 years. And then everyone jumps in, and then it gets overfunded, and then that's the commodity cycle. And then so you've got your early inflection where a lot of the big money's made, and that 3 years been early, but that's obviously the pain because you don't know when that's actually starting. You got the inflection, you got the smart money, institutional money comes in for 6 years, and then you've got the sort of the overall kind of whole retail boom. Everyone piles on, and then there's the resulting glut, and then rolls over a sort of, I think it was year 12. And so I always found that kind of interesting. And he was just saying that all these big players are very slow to pull the trigger. And I was even just having this chat with Robert Mullen, and he was talking about how slow, say, the losses some of the big European pension fund, or not pension funds, but just large European allocators have taken on their US assets just on the currency, and how slowly they will start to rebalance. Like they can't sort of, they don't move quickly. Like they're moving trillions of dollars, and it takes a long time. And I don't think sort of allocating to commodities is any different. Yeah, there's like spikes in certain areas, like when everyone gets super excited about like lithium, but I think we're talking about sort of a really big sort of intensive capital spending boom. I think it's going to take a while to really gain momentum. So and need to see because there's been that much capital underinvestment in most of these sectors as well. Like it's just been absolutely capital starved for a decade now.
Mm-hmm. When we think about how, the volatility moves a lot of this stuff around, and especially I think an interesting, let's say, case study was the recent Iran-Israel 12-day war here. Were you surprised by oil and gold's reaction, let's say, to the conflict and the way that it developed? Or did you kind of sit back and understand that the market basically knew better than our knee-jerk reactions would have expected it to be moving at that point?
Yeah, I wasn't really surprised. I guess it was like I don't really put much weight on like geopolitical. Like if I'm trying to trade around that or anything, I just if anything, I was a bit frustrated by it because I felt it was like letting like that spike in oil just allowed a lot of the shale to hedge high prices, and that sort of stopped, just dragged the whole, what I see with shale rolling over, sort of drags it out another 6 months or so, or longer. But regarding the geopolitics, it all felt a bit sort of, let's say, it all felt like a bit of a show to me. Like I saw, even with the sort of attack on the Qatar base, was it oil started to, I just saw Dr. Ananas, he was talking about it, and he was saying that when you looked at how everything was trading at the period, it was obviously news had been leaked previously that it was essentially all for show, and that there wasn't any, that all cleared out the base. And as we saw oil roll over quite quickly following that post. So yeah, for me, I don't really put any weight on any of that. I'm really concentrating on the sort of longer term fundamentals. I've never made any money on sort of playing anything geopolitically, or granted, if it's a big event, so be it. But I've found there's never any edge trying to take advantage of geopolitics. So even politics is super tough. So yeah, I watched it. I found it all interesting, but yeah, I didn't didn't really do anything around it. I try and my mentors always kind of rammed into me like, will this matter in 5 years? You should be positioning for what you want to see and with your investments in 5 years, and that's where you have a real edge. Trying to do anything on a shorter time frame usually leads you astray, and I do dumb things when I do that.
Well, I think it was interesting to look at exactly as you're saying, right? I think it's a perfect example of, let's say, having an expectation and then not having it met by the market, and the market really understanding whether that's through, let's say, the tankers that were in the Gulf not calling their trading desks, as a recent guest had explained it. Basically, the tankers didn't get right on the phone and say the Strait of Hormuz is closing or we're under attack. That would have served as a catalyst for the oil price, and that would have being known by the market quite quickly, I think, rather than just the basic non-reaction from the rest of the market. So I think it's instructive, especially in the case of what you're saying of looking at these things over a longer time frame.
No, I was just saying as well, is it is instructive that there's obviously, with all that going on, and price didn't really spike and came back down as quickly. It is instructive that there is adequate supply, and that it is it didn't escalate, I guess.
You have recently posted a couple interesting ratio charts that I kind of wanted to ask you about and to dig into a little bit. The first one being, let's say, the gold to coal ratio. What is that? What does that tell us, and how do you find it instructive in your views?
Yes, that one really interests me, because I've never seen a chart like that is so clinical. You could have made a lot of money just going back and forward between coal, and then it sort of begs the question, with it spiking to a high now and coal being so cheap, bottom crawling, and I can see some catalysts appearing, like, is this actually going to be yet another period where coal really outperforms and maybe gold just chops wood for a year or two? And it's kind of fascinating to think, because at the moment it feels like gold's got all the momentum and coal's got none of it, and so that's kind of
exactly where we want to be.
yeah, exactly where you want to be, and it's almost a contrarian trade, like roll your gold into coal. I don't. Yeah, so just starting with that whole framework, it's my latest piece I'm writing at the moment. Is I've got this like really digging into the idea now that, are we going to see really an Asian boom moving forward for a number of reasons, and the effect that that's going to have on the whole energy complex. And I kind of find this whole topic really fascinating at the moment, because someone that I really look up to, and it's his framework is we're like kind of looking at a reverse Asian crisis, and it's Lewis Vincent Garve. And it's just the fact that a lot of the Asian countries were really constrained by the US dollar, so they've had to run surpluses. A lot of their growth has been held back because they have to hold large amounts of US dollars. Yes, they run the surpluses to hold large amounts of US dollars, and then they use the US dollars to get to buy the commodities, particularly the energy they need for their growth. And so with that model, they're always kind of slightly hamstrung. And what's changed recently is they can now start to buy what they need in their own currencies increasingly, so they can buy the energy in their own currency. So that relieves them of that need to hold the US dollars, which relieves them of the need to run big surpluses. And so they can buy more commodities. They're more supported by China. They've also got this tailwind of cheap energy, a weaker dollar, and China stimulus. Then Asia could be really looking at like quite a boom, and that has massive implications for energy when you. So I think before we started talking, I was running the numbers because I just found this really interesting. There's if you break down total global energy consumption, take it from 1990 to today, it's increased 84%. Of that, Asia represents 77% of that. 70% of that growth, and they are 60% of the world population. They're 48% of global energy demand. Whereas when we always talk about energy, we're always quite sort of Western centric. Whereas over that period, US only added 5% to their energy consumption over that 25 years. Europe's actually lost 8%. The Russia whole CIS complex, they've lost 17%. And a lot of that's because the industries largely moved to China and the rest of Asia. And so where I'm going with this is the fact that if Asia has this this bottleneck taken off it, which was sourcing enough dollars so it could buy enough energy, and it's the main driver of energy consumption globally. It's got some of the best demographics. Then that's super bullish for energy, and that ties back to the gold to coal ratio. Is that if we can continue to see dollar weakness and continue to see trade ramp up between the Asian countries, then that's super bullish coal, oil. Just at a time where a lot of these things are like absolute hated, pricing recession. Like oil's just about as beaten up as I've ever seen it, and yet the Asian countries they import. I think it's 77% of global oil imports go to the Asian bloc, and there's been. I've kind of known this is a big energy driver for a long, in a lot of my work previously, and the fact that when you break down the world by energy consumption, and I always use energy consumption and sort of economic growth like interchangeably. Like a lot of that, you don't get economic growth without sort of access to energy. And so if you break it down with developing countries at the moment, call it 1.5 billion people, they consume roughly 12 or 13 barrels per person per year. You compare that to developing countries, which are 6.5 billion people, and they are consuming 3 to 4 barrels per person per year. And then you understand that 6.5 billion people is going to add another 2 billion people over by 2050. So that alone kind of adds 50% to the entire energy system. And then if you assume that they're going to add another barrel or two, and that's not a tough kind of conclusion to arrive at when you look at places like India, which are at like 1 barrel per person, or somewhere like Thailand, but like they just want to get closer to somewhere like Thailand that's at 6 or 7 barrels per person. I think China's at 4 or 5. So everyone's just trying to increase their standard of living. And so that's just an absolute ton of energy demand that's coming, and they're all going to be able to access it when they're not constrained by the US dollar moving forward. And so I spent the vast majority of my time focusing on the supply, but this is like really quite a large bullish case on the demand side. And I don't really see anyone talking about it other than the likes of Lewis Vincent Gov.
Or do you take any consideration towards the demographics? As you said, the Asian bloc will add 2 billion people over the next, what would that be, 25 years, I guess.
Yeah.
I've had a demographics expert on the show. I've had a couple of people talk about this, basically this tipping point, this rollover of the demographics issue, especially Japan, the birth rate being below replacement value. I believe China is really close, if not already rolling over as well. So what role do you think that demographics play in there? And do you question those assumptions of that addition of 2 billion more people?
Yeah, so to start, it's not 2 billion just in Asia. A lot of that does come from Africa as well. And yeah, like if you look at like some of the places like Nigeria, it's just crazy. And going into that, the energy consumption, I think Africa from 1990 to now, it's doubled its energy consumption, but it's off a really small base. And so, yeah, you can definitely question some of those, the growth rate and some of those demographics. But overall, I don't even think it matters as much as the like you can really dial it down. Like you can half that amount, and you can kind of still get to a really bullish setup just with the increase in standard of living. Just the increase from 3 barrels per person to 4 barrels per person. And I think we're seeing that really clearly. Like I live in Indonesia, and I joke that it's all anyone wants is first to get a smartphone so that they can entertain themselves and have work, and then they need to get a scooter so that they can now have a job. They can work as a scooter driver, like on Gojek. They can do food delivery, kind of like Uber Eats type setup, and then from there it's additional energy consumption, like a refrigerator or a air conditioning at night is the big one here in the tropics. Like it makes life so much better when you can run your aircon when you sleep. And so there's just 6.5 billion people that just want to increase their standard of living in that way, and that's massive addition to sort of energy demand, regardless of if the demographics live up to the full 2 billion. And then you got to remember there's also a large, I want to say it's like 500,000 or 600,000 that still don't even have access to electricity, because a lot of people still to even sort of aren't even at the starting blocks for that increase in standard of living. So yeah, I see Asia's at the start of their S curve rather than whether or not a lot of that demographics kind of plays out in Africa. I'm not as confident. Yeah, not as sure.
Mm-hmm. Yeah, when we were kind of bouncing this idea back and forth before we hit record here today, it was like the way you're explaining it, these next steps for many of these countries are almost the most energy intensive steps, yeah. Right? Having a smartphone, getting a vehicle, and then the consumption of electricity for refrigerators and air conditioning. It seems like that is, these very meaningful and high sea change type next step for especially energy.
Yeah, like people just don't understand how large these jumps are as well. Like anyone, it's really instructive to look at a place like India or even China. Like they can have years when they'll add 8-9% to their energy demand, which is just absurd when you consider like US kind of like can barely add like 0.5% to the sort of grid over years, and like they're adding that amount to the entire sort of entire energy complex, and it's leading the last few years when we had sort of slower growth, because then the renewable segment makes up a larger proportion. But when sort of growth roars back, it all has to come from fossil fuels, and in Asia it's pretty much coal, and so coal has to make up that. It has to really jump to meet that increase in demand. And yeah, that's what I look at when coming back to your very first question, when I look at that gold to coal ratio. It'll be fascinating to look back on that in another year or two, because you've also got the likes of Luke Groman, who puts forward a very convincing argument that gold's going to be used to recap the whole system, and that the gold ratio is going to continue higher against the entire commodity complex, and gold's just going to have to be constantly revalued. And so that argument's that kind of ratio is going to continue to break out, and gold's just going to keep getting more expensive relative to coal. Whereas kind of what I've just laid out, I can see a scenario where coal does gain some performance back against gold. Not 100% sure which one plays out. own a decent amount of coal and I own a decent amount of gold, so I'm kind of playing it both ways.
Yeah, it's definitely an interesting chart, and that's one of the other ratios that I wanted to get your explanation of. You know, you wrote that the release valve of global inventory pressures will continue to be the gold/commodity ratio rather than the price of commodities. So is that what you were just explaining, that gold is going to continue to outperform the rest of all of these different sectors that have this cyclical nature and have a positive fundamental setup, but because of the need of gold to basically act as a counterweight to all of this debt and recapitalize the system, that keeps gold propelling forward?
Yeah. So I think this is the toughest question to answer at the moment. So I had a podcast with two people I really respect, Paulo Macro and Chase Taylor, and this was one of the big questions I chucked at them was like, where do you see this playing out? Is there just going to be a big opportunity cost of not just pretty much being in gold for the next few years? And because in that quote, in a quote from Luke, he's just saying, everyone has essentially the wrong framework, and that this isn't the sort of 1970s commodity bull market. Everyone's got the wrong framework. This is a gold recapping the system. And so gold is going to continue higher against the entire commodities complex. And that's kind of concerning, because I've kind of basing a lot of my views on the history of the 1970s, like kind of commodity bull. And the conclusion I reached from that is, I think like both are right, but the fact is that nothing goes in a linear line. So I think gold probably does continue higher against most commodities. But if you look at the vast majority of commodities, there's massive sort of like spikes and reversions. And this is someone else I've had on recently, was Kevin Bramber, and he's like, it's a game of whack-a-mole. You just have to, like using the ratios, you just have to work out what's cheap, what has a tight supply-demand setup, and you whack it at the time that it looks the best. And an example of this is platinum has outperformed gold this year to date anyway. And so, if you'd traded between them or owned a bit of both of them, you'd always have something that would be outperforming, and maybe you trim one when it gets just basic portfolio rebalancing between it. Maybe gold probably is over time going to grind higher, as I do kind of subscribe to the fact that a lot of what I was talking about on the back of Asian countries not being beholden to the US dollar, that requires them to trade between each other, because there's kind of a lack of trust in their currencies. A lot of that will be net settled in gold, and gold market needs to grow a lot larger for that to occur. And so on the back of that, gold will probably keep gaining value. And so, I just come back to the way you play that is you just have exposure to gold miners, because they're still so cheap and hated and have so much torque to a higher gold price. And if the gold price keeps overshooting, then you partake in that. And yet with all the commodities, you just keep an eye on how tight the supply demand is getting and keep allocating to the ones where it's the tightest.
Mm-hmm. Excellent, Ferg. Well, I think that's a good place to kind of wrap up for today. Is there anything that you think maybe we didn't touch on today that you want to leave our listeners to think about?
Not really, other than I think there's just a lot of value at the moment, and just keeping an eye on a lot of the commodities that's similar to what platinum's just gone through. You can just see it's just a gradual decline in stocks. Like another one that I like to talk about occasionally is tin, and it's going through. I think tin's like the next shoe to drop after sort of follow sort of platinum type price action. The fact that you can see inventories drawing down. The inventories in Shanghai have been gradually drawing down. On the London Exchange have been drawing down, and if you can sit around on something like that you understand there's demand for it moving forward. Suppliers in trouble. A lot of the main suppliers continuing to underperform, like in Myanmar and Indonesia, you just know that you're going to have a good outcome if you have patience and just have that fundamental view. And that's just where I kind of like to focus on. I guess it's Kevin's statement of playing whack-a-mole, or Paulo Macro calls it rolling bubbles. You just want to catch the next sort of rolling one that's about to run next. And so, yeah, that'd be the one thing I'd like to touch on is just, and I think it's not going to be a commodity market where just absolutely everything runs together like it did in the early 2000s. Man, maybe it does, but for me, it looks like there'll be lots of individual runs with gold being the overall trend. Like gold will be kind of like the S&P, where it's just, if you don't want to have a view on all the individual commodities, you'll do just fine owning that for the next decade. But there'll be lots of periods where some other commodity absolutely creams gold for maybe a month, maybe a few months or a year. And so tactically bouncing back and forward is probably going to be pretty profitable.
Yeah, I think a valuable way to look at this is to slow down and think about this through that longer term time frame, right? And not get disheartened by, seeing Nvidia up 10% on a day or something like that, and understanding this fundamental setup that's in front of us, whether it is gold, whether it is oil, whether it is platinum, silver, uranium, any of these things. There's so much fundamental potential for all of them, and deciding what you will accept for opportunity cost or when you're going to get in, and understanding that it might take some time, but eventually we're going to be proven right, I think is an easy way to sleep better at night, right?
Yeah, no, that's the main thing is I sleep really well on a lot of the stuff. Like just talking about coal, like I got one position I own, that's 85% cash, has a 6.5% buyback, and pays a 12% dividend. And it's just I sleep fine on that. Even if coal doesn't do anything for another year, I'll be fine.
Yeah. Well, that's funny because I literally just finished recording with Chase Taylor this afternoon, somebody that you just spoke with, and he said the same, very similar thing about being in gold miners. He said, I don't really necessarily need them to move as long as they keep doing buybacks and having an excellent dividend. He's like, why would I want them to move? I'll just hang on to that.
Yeah, I love that framework, because I read a quote from Ian Castle, and he was like, how you find the serious multi-bagger is you just have something that you can pencil out a double in a year or two just based on buybacks, dividends, fundamentals, like the most conservative assumptions that get you your double. And then the rest is usually just a surprise, a nice surprise. Yeah.
Yeah, absolutely. Excellent, Ferg. Well, of course, all of your extremely thorough and interesting articles full of charts and a little bit of entertainment to keep things interesting. That's all available at traderferg.substack.com, and of course on X at trader_Ferg. Ferg, thanks so much for your time today. I always appreciate getting to speak with you.
Thank you for having me on, Tom. It was a pleasure.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.